we know President Trump put Elon Musk as the head of Doge, right? So one other thing that I see it happening in, part of the macro picture that has changed for me over the last month or so, which I kind of talked about on the channel even before everybody's talking about, is it's pretty clear of what's going on, okay? So as we know, during the first term of President Trump's first term 4 years ago, he would talk nothing, a lot about the market, right? The market's all-time high, market's all-time high. Well, now he's not talking about any of that. They even asked him, and he said, I don't watch the markets. I'm like, well, that's the first time, right? But to sum it up, President Trump believes that short-term pain for long-term gain. I think that's the theme now. And, well, they're doing it. I mean, they are definitely talking that game, from President Trump to Elon to Scott Bessent, who's the Treasury Secretary. They're all talking about it, right? Well, is it going to work? Is it super risky? Yes. Are they intentionally going to put the economy in a recession? Well, we're going to find out. But the market, Mr. Market, was pricing in a soft landing. And so that's getting definitely priced out. Okay, because soft landings, and I talked about it 2 months ago on the channel, soft landings are not easy to do, and we have maybe less than a handful in our history. Economy is just too big to soft land on hard land. But I think now what the market is doing now is definitely discounting soft landing. That's one. The other thing the market is doing now is pricing in. So my market, for me, is the best pricing mechanism on the planet. There is no better pricing. It could be right, it could be wrong. It could overshoot, it could undershoot. That's not the issue. But the price you see here is the scoreboard that you need to follow. Just like when you go to a basketball game, you're watching the scoreboard, right? Yeah, one team is playing great, the other team is winning the game. Doesn't make any difference. Scoreboard is scoreboard. So you need to be really cognizant of that, as opposed to, creating personal biases and things like that, which will hurt you in many different ways. So, President Trump now believes short-term pain is the only option to lower inflation and refinance $9+ trillion. And I'm going to talk about this on the next segment, is $9+ trillion of U.S. debt that's coming due. Well, about September 18th of last year, Fed started lower interest rates by lowering the Fed funds rate 50 basis points. And I was kind of questioning, why are they doing this if the economy is really strong? Well, now we're finding out, aren't we now, right? Last 2 months, consumer sentiment is in the toilet. Actually, inflation is kind of ticking down a little bit. And President Trump wants lower interest rates and lower inflation. Okay, so how do you achieve lower interest rates? You can't just tell the Fed lower interest rates, because Fed's not listening to Trump. And they're not in the same camp. So Fed goes, well, we're going to watch the data and do accordingly. And the Fed goes, well, no, it's not time to cut the rates aggressively yet, because it may bring inflation back. Well, then, the hat's changed, it reversed. So now President Trump is talking about lowering inflation by potentially, intentionally slowing the economy down, potentially putting us in a recession. So now they're getting the pain out of the way, because look, it's a 4-year term, right? We all know that. They haven't been even in Washington for 100 days yet. And the message is pretty clear to me. They're going to slow the economy down, because 80% of our GDP, of $28.5 trillion GDP, 80% of it is consumer spending. Consumer is stretched as it is, to the point of credit card debt is through the roof. And, defaults are happening already. And we know Fed's target is 2% inflation with full employment. Well, that didn't happen. That's not happening. Inflation is sticking around. So in order to lower the rates, we need to lower inflation. Okay. How do we do that? Well, we put ourselves in a recession. The only way you can lower inflation is slow consumer spending down, because the true definition of inflation is too many dollars chasing too many goods. The other thing you need to do to lower inflation is, cut spending. The other thing you need to do is control the debt, so that, the Fed doesn't have to borrow money because Washington's fiscal policy is broken. So all these things are coming together. The picture is really coming together now. And a lot of people in Washington, in the cabinet, are talking about lower interest rates than higher stock market. Okay, well, how do we lower interest rates? Well, we lower interest rates when we put us in a recession, because then the Fed is going to be forced to pump, right? Then the Fed needs to lower the rates, especially the long-term rates that affect mortgages and car loans and things like that for major purchases. And then, by the end of the 4-year term, because this administration is not only looking to cut spending, but they're also looking on the deregulation side to free up the economy, or some more economic gas, or to increase the GDP that way through deregulation as opposed to regulation. So they have a plan. The plan is pretty clear. They're going to slow the economy down to the point that then they have enough time to put the gas on, and then by the time Trump is finishing his second term, these 4 years, economy is booming, stock market's at all-time highs, and all that good stuff. But I kind of agree with this short-term pain for long-term gain, but I'm watching it closely, and I think for a lot of people, short-term pain is obviously painful. I mean, we see what the market is doing. Market is pricing in a slowdown. I don't think it's pricing a recession. I think when the market prices a recession, market will be down about 30% from its all-time high, and that's my target. My target is on S&P is 5,000. I think we're going to see those levels when it's all said and done. And as we know, market's 6 months ahead. Market's always 6 months ahead of what is happening. And will we overshoot? Probably. We always do, right? But then the important thing is, again and again, keep your cash together. Yes, be nimble. Take some small losses if positions are going against you. Don't put your head in the sand and say, oh, it's going to be okay, it'll come back. I've seen this movie before. It's painful, but you survive, especially if you're watching me, because I will give you some good advice, and not about trading, but about the macro picture, and because these things move slowly. It's like a rolling train. A lot of people have these days no patience. They just expect market to go down, bounce right back up, make all-time highs. It doesn't work like that. It never did until the last 2 years, where everybody became comfortable, or through the pandemic, where everybody was sitting home flipping options on Robinhood. People just became completely too short-term oriented. And to me, yes, you may have a trading account that you do short-term stuff in, but then you're trying to create generational wealth. And then it is true that if you do buy after the market draws down 25-30%, for long term, you will make money. That's what you should have. You should be thinking of investing as opposed to just trading and making the quick bucks. This is not a sprint, it's a marathon, so act accordingly.